This episode is brought to you by Helmuth & Johnson, a top Minnesota law firm ranging from individuals to emerging startups to multinational Fortune 500 companies. Focusing on transactional law, litigation, and appeals, Helmuth & Johnson attorneys are leaders in their field. David Helmuth and Chad Johnson joined forces 30 years ago in 1994 with the goal of creating a premier law firm capable of handling complex and challenging cases efficiently and effectively. Today, Helmuth & Johnson rank among the top 15 largest law firms in Minnesota with more than 70 Twin City lawyers serving clients in more than 30 legal practice areas. They offer a full suite of legal services to clients without sacrificing their original commitment to providing responsive and affordable legal representation. To learn more, go to their website, www.hjlawfirm.com. Today on the Curious Builder Podcast, we have Steve Berg and Eric Britt with Minnesota Bank and Trust. And we had a great conversation about all the things that banking can do for a construction company, but just businesses at large. And one of the things that was really interesting to talk about is just how your banking partners need to be a part of your inner team. And that includes your lawyer, your insurance agent, your CPA, maybe a building coach, and potentially even, as Eric points out, a succession planner. So I hope you enjoy this episode. And without further ado, let's talk to Steve and Eric. Welcome to the Curious Builder Podcast. I'm Mark Williams, your host. Today I'm joined with Steve Berg and Eric Britt from Minnesota Bank and Trust. Thanks for coming on, guys.
Thank you.
Thank you.
So I've known Steve for a number of years now. I've been with Minnesota Bank and Trust and the bank I was before, Signature Bank, for, my entire career, 20 years.
Correct.
And actually, my dad helped start Signature Bank way back in the day when Ken Brooks had first started it. So we've been there for quite a while. We've got a great relationship. And Eric, this is actually the first time I've ever met you. So nice to meet you.
My pleasure.
I wanted to bring you guys on for a number of different reasons. We have recently had on some lawyers, and we've had a CPA on previously. And I kind of want to talk about, to our business owners out there, kind of like your leadership team. We hear a lot in the corporate world, or, have your leadership team. And like, what does that mean? I think every business owner needs to sort of have their, let's say, 5 sort of outside counsel. And I would say your banker is probably number one. It's probably one of the first people you ever meet when you decide to do a spec home or start a business. A lawyer, your insurance agent, your CPA, and potentially a coach. And so as you're kind of one of the 5, most important pegs in any business, I really wanted to compare and contrast the construction world with other businesses that you guys manage. So with that kind of in mind, why don't you guys give us a brief intro to yourselves individually, and then maybe a little bit of an overview with Minnesota Bank and Trust, and then we'll kind of talk about the banking world.
Great. I'll start here. So first off, thank you, Mark, for inviting us over here to do this podcast. As mentioned at the beginning, we've known each other for quite some time and get involved with not only your business, but obviously with some of the clients that are building with you. So it's a great win-win opportunity for us. We are super appreciative of the relationship and look forward to continuing that because at the end of the day, it's a mutual play. Once you get that trust level built up, as we know, that's the number one piece. I've been in banking for 28 years, so kind of been around the block when it comes to just seeing and experiencing everything. And when I first cut my teeth out of college, I started at TCF Bank, got to learn the ropes, but realized that it's all about relationship. When I was there, I never had that connection with clients. It was always moving on to the next bank to get up in the scale. So I made a pivot about 6 years into my career looking for a community bank, and for those reasons have spent my entire rest of that career up to this point in that relationship/community bank world or regional bank world. And really at the end of the day, we're going to hear, I'll probably say it, Eric will probably say it, it's relationship building. I want to know my clients. I'm in the private banking space, and really what I bring to the table that's completely different that we feel to everybody else is just a full-on relationship. I know about people's families, people's kids. And at the end of the day, that should be what it's about. I want to know more than just doing a transaction for a client. I want to be there to help you plan out what your next step is. And with that, I partner with Eric and Eric's team on a commercial side when it comes to just anything within the banking sphere, even if it's not in the bank. Hopefully I built enough connections where if you come to me as, I'm being your trusted advisor, there's somebody that I know that I can confidently refer you over to. But we want to be there to partner with the client on either side of that equation, from either the private banking side, as mentioned, to the commercial side. So appreciate the opportunity to be here. I'll turn it over to Eric.
Sure. So the trusted advisor concept, that's kind of the holy grail of what we're trying to do. I've been a banker longer than Steve, pushing 40 years, and I've actually got clients who I've banked 3 generations. And that's truly, that's what you want to do, where they come to you, where you're not just a peddler of product, that you truly are a trusted advisor. I would also suggest that in that group, that every private business at some point is going to sell, right? Either family or outside. And so they should have somebody on the team on the wealth management side, succession planning. I think you should always be anticipating that, thinking about that.
I wish we had met. I'm 43, so I wish we met when I was 3 years old, Eric, because nobody tells you when you're a 23-year-old kid. When I started my company, about you just starting a business. I mean, that's the last thing you're thinking about is 50 years or 40 years after your career when you first start. And one of my biggest regrets, and I've talked about it many times on the podcast, and I feel like a lot of construction industries fall into this trap, is, we named it after ourselves. Genius move, and so, anyway, it's a little late now for the rebranding.
So you could have Mark Williams and Sons. True.
And I do have some sons, so we'll see if Simon and Tate want to take it over. And it is interesting. I think a lot of my contemporaries, we've talked about that. And I think maybe a year or two ago, my common line to that was like, I sure hope they don't show any interest because I don't want to keep working that long. However, now that they're getting a little older, and I'm like, well, I could see it. That would be really fun. So to that point, yeah, you're exactly right.
I used to have a contractor customer who was ABC or Joe Blow and Sons, and I asked him about his sons. There weren't any. He just thought that made it sound like it was going to last for longer.
Great marketing.
Huh?
Love it.
Yeah.
I mean, you can market what you can sell, and you can sell what you can market. So I like that. Well, maybe before we go into a little bit more of banking, what is it about? I'm just curious on the personality side. I mean, 40 years of banking is no joke. You can't do that without having a passion or an absolute whip behind you. So which one was it, Eric? What are you passionate about when it comes to like banking? Like what excites you about it?
Oh, I just like serving customers. I like relationship building, being a trusted advisor, solving problems, taking care of customers. It's a service business. I always viewed it as a profession, although I realize that if you're a doctor, a lawyer, a CPA, you actually have to pass a test. But banking you don't. You just have to have a smile and a shoe shine, and you can call yourself a banker. You have to have some aptitude for numbers. Bankers like updating their personal financial statements once a week. And we have customers, and we beg them to do it once a year. So you have to enjoy numbers, enjoy aptitude, but you have to like serving customers.
Yeah. I mean, I think how about for you, Steve?
Yeah, I'd say the same thing. I mean, really, as you heard me say at the beginning, I realized that the connection with the person and to grow with them was what drove me, is that I wasn't there just to solve a one-time problem and then they're going to move on. That one step that we help them with usually catapults into 2 or 3 others. And then, as Eric mentioned, with generations of family, you start getting involved with kids. You start helping them plan for next steps, going through college to whatever it is. That's the passion play. You got to be in it for really helping those individuals, those families, continue on through life. It's not just a transaction. It should be.
What percentage of your banking relationships, so we'll say businesses, how often are, as a general rule, they meeting with you? And I'll just use myself as an example because I'm talking about that you should do this, and I'm a hypocrite because I don't. I basically reach out to you when I have a question, which is I do have a lot of questions. So by that alone, I tend to reach out to you, probably every other month, or if I'm scheming on something, we'll go back and forth. But do you have any people that keep like, hey, we're going to meet every quarter. These are the things that we have coming up where you can actually be an advisor? Because I assume you have, I don't know how many clients, hundreds of clients. And so you couldn't actively know every single thing that we're doing unless we're sort of inviting you in and telling you about it. How do you manage that relationship? And I imagine personality comes into it. Some people only reach out to you when they have a need, and others, I think there'd be a huge benefit in some just strategic sit downs. Walk me through a little bit about what you think would be good advice for business owners that are listening. But even for myself, I mean, this is something that I'd like to employ.
Yeah. I'll start real quick, and Eric can talk on the commercial side. So from private side, it's really understanding the cadence or the needs and desires of that individual. And what I mean by that is it's what do they feel most comfortable with? And sometimes we need to push where we're going to say, hey, at least at a minimum for this first year, we're going to meet twice because I know you have these 3 things coming up and we want to stay in front of it. We never want to react. We always want to be proactive because usually when you're reacting to something, time is of the essence and everybody gets flustered and life goes on, but you don't want to be behind the 8 ball. So if we're proactively meeting with those clients, and at a minimum, it should be a touch point of at least face-to-face once a year at a bare minimum. I have I'd say, connection with most of my clients that we connect by text, we connect by phone, cell phone. There's no more bankers rules, bankers hours. I wish martini hour started at 2 every day. It doesn't. And that's okay because I feel like I'm more connected with my clients, that if something arises at 8:30 at night, they have something they feel is fraud, I want to know and I want to help them. We want to get in front of that. Long story short, it really depends on the client, but that minimum piece should be every year at a minimum. We're trying to get at least quarterly touch points based on however the client wants. That could be that text, it could be a call, it could be a Zoom meeting, it could be face-to-face, but whatever that preference is, that's where we come from.
So on the commercial side, it really depends on the size of the business. So if you're dealing with the owner, entrepreneur, that's one thing. And then if you get a little bit larger company, they might have a controller. So now you got 2 people that you want to get in front of. And if you got larger companies, they might have a CFO, a controller, right? And so you might have a different cadence for the different clients. I'd say on the commercial side, it's probably at least quarterly because we have fewer clients. They might be a little bit larger. And some of them, it's monthly because you're getting monthly financials. You want to touch base with them. But it's generally partly left up to the client. And then I guess if they're up to their eyeballs in debt with the bank, then the bank is probably going to want to talk to them more often.
Right. How, from an analysis, one thing I've really appreciated about Steve and our, working together over the last couple of years is, I'll have a question, and I really appreciate your emails. They're succinct bullet points, which is how I like to read emails. But it really helps. I can see like your logic train going through it. Right. And you have a very good, I don't know if it's unique in the banking world, but it's unique to me. You have a really nice way of breaking down numbers in a way that you can sort of understand in a business sense. I'm curious, how often do you have to explain this to business owners, or most business owners are obviously going to have some sort of financial literacy that they're going to kind of get it. But I guess walk me through a little bit of like how do your clients respond to you when you do that? How often are they like, oh man, thank you, versus them not having any idea what you're even proposing to them, and they need more of a in-person sort of walkthrough on it?
It's a great question because over the years I've tried to perfect what does a client really want or need. I think that's the biggest play. You got to react to each client. What are they doing right now? Are they just kind of high leveling things right now? Like, hey, I kind of want to see if this would work in the future. If they're at a point, and let's just say it's purchasing a property, and they want to know what does their cash flow look like, or how is this going to impact my daily? You want to get into the weeds a little bit to make sure that you're guiding them, you're helping them, you're answering directly their questions, but you can't bore them with a whole bunch of verbiage. You got to keep it simple. You got to keep it succinct. Got to keep bullet points. That's my play. But it's one of those pieces where people appreciate that. They want to be able to see it. As we talked about, the trusted advisor, in my opinion, is somebody should be coming to me looking for a solution. How do we get there? And my job is to give them a high-level overview. It's kind of like in my family household with my wife. She's in IT. She wants to know what's going on, but if I start going on into details, she's going to be like, yeah, what are we doing tomorrow? She comes to me. She says, give me the 3-level bullet points of what that conversation was about, or what we want to do if it's financial planning, buying a property. And she just wants to be informed, but not to the point where it's overbearing or it's too much, because that's where you get at the deer in the headlights look, and you really don't want that. So I've always found it, keep it clean, keep it simple. If you need to go deeper, that's fine, but don't try to do a whole book in an email. Get to your point, answer it, and go forward. So
commercials, I would assume.
Commercials the same, but I think if you're dealing directly with the owner entrepreneur, that's where a private banker like Steve can really add value, right? So if I'm talking to a CFO, they're probably they have more financial acumen than I do, right? So in some cases, you can be almost an order taker. When you're dealing directly with the owner or entrepreneur who doesn't have the benefit of a controller or CPA, they really are relying more on the banker to give them good advice.
That is actually really helpful. I was going to ask you what the difference between construction lending and residential lending is, but I think you just answered it, Eric. Is that I mean, obviously we're a small company, right? We're a team of 3 or 4. And even at our biggest, let's say we're 5 or 6, well, we have, someone who's very good with numbers in the office manager role / controller role. I mean, they are not a CPA or a CFO. And so I imagine one of the things that we've tried to do is align ourselves with different companies that help us with our books or people that help. I'm really more interested now in my career after 20 years of the strategic side of things, which I don't know why I never thought of that years ago, because that would have been very helpful. But I'm thankful for people like a Steve that can really sort of break it down. Because I'm good at building homes. I want to be good at selling, and so no one person can be good at everything. And just like you need your CPA or your insurance agent, I mean, you sort of need a team around you.
Correct.
Yeah.
Correct.
Well, in terms of like lines of credit, short-term loans, for those out there that don't own a business, can you just go high level a little bit? I mean, I'll just use I'll kind of lead with this. For 20 years, I never had a line of credit. I mean, I essentially ran a cash business. I was very uncomfortable with debt. I feel like personally, and I've spoken about this on the podcast, that I probably hindered my own financial returns by being so debt averse. That being said, I don't have a lot of debt, so it allows you to have a little bit more flexibility. But you look around and you see people doing a lot of spec homes or land development, and you it's not that you're envious, you're just more like, oh man, now I get it. I see the opportunity there. And Steve and I have just talked recently about kind of my desire to get back, even though interest rates are relatively higher than they were, several years ago. Historically, they're not crazy. Mm-hmm. And so the idea is, okay, what does this look like? Walk me through the businesses that maybe we'll just stay on construction for now, but we can talk globally about all businesses. Walk us through, like, how does a business know what kind of line of credit that they want? How big does it get in terms of percentage? I mean, and how, as a bank, do you judge who's safe and who's not safe? I've always kind of been mystified by that. Like early on in my career, I didn't have a family, I didn't have much. It was like, I remember having other people sign. It used to bother me so much. I'd have a home that was actually sold, and the bank used to actually require me to get a co-signature. I'm like, the house is already sold. Like, how many signatures do we need on this? And I get it now. In hindsight, I was 23 years old, and I'm like, okay, yeah, I can see now why the bank probably wanted some additional collateral. Anyway, big question, but how would you unpack that a little bit for the audience?
Yeah, I'll start real quick, and I think this is a little bit more towards Eric's side, but you heard me say at the beginning, I've always taken a proactive approach with my clients. So they may come to me and say, hey, everything's going great at work and whatnot, but you never know what could come up, or there might be an opportunity that, maybe I'll strip it back a little bit here. A lot of my private banking clients have been very successful, and they have a wealth management account. They have investment accounts. They have some rainy day or emergency fund money that's liquid, but that money should be proactively working for them. If there's an opportunity, and doesn't matter what that opportunity is, buying something, investing in something, the worst thing, in my opinion, to do is just go out there and liquidate a stock position, for example, because they've been very good savers. They have no debt. Liquidate it, cause a tax obligation just to buy something that could be beneficial in the long run, because you can strategize then with that trusted advisor in the wealth advisory space to say, okay, maybe we shouldn't just liquidate everything. There's a strategic way to liquidate this to be tax advantage or tax harvest properly through this process. So my point is, be proactive and get some type of line of credit set up. In the private space, maybe that's $100,000. Maybe it's $50,000. We kind of analyze what that is based on someone's financial position, and it doesn't have to be secured. Possibly it's unsecured. Whatever the easiest possibility is, we try to be proactive to get it there, so that way we are not reactive, like you heard me say before. So a little different on the private side, but Eric, if you want to step in on the commercial side.
Sure. Startup businesses or new businesses, that's challenging. On the commercial side, you're looking for historical financial performance. And if you're just starting up, you don't have that, right? You haven't sold your first house. But there are programs with the Small Business Administration, SBA, that encourages and incents the banks to take a little more risk to create jobs. Credit card is an easy way to for a new business to start out. Get a credit card. It gives you some working capital because you can charge things, pay certain bills, and then you don't have to pay for the bill for 30 days. So you've presto got working capital. And for small loans, generally we're underwriting it based on the personal credit score of the owner anyway, right? So it's a pretty quick turnaround. We're not doing a lot of analysis. Once you get a little bit bigger, then we're looking at the assets of the company, the cash flow, the earnings, and what hard collateral there is to support a line of credit.
When you're doing the loans, and it's been a while since I've done a spec home, I think it's been 13 years, and I remember maybe at the time, walk us through a little bit, you always hear builders talk about, oh, my banker made me do a personal guarantee. Oh, at what point does a loan or a company get big enough that they either don't need a personal guarantee? Or walk us through, like, how does a bank, and not just your bank, but most banks, like, how do they look at that? Because a lot of people get concerned about, like, man, I mean, the reason I'm taking this, I'm already a business. So if you're in business, you're already at risk because you're a business owner. You signed up for this, I guess. And if you didn't, well, welcome to the club. And so anyway, as you go through that, you're like, okay, well, not only is my business essentially going to be liable, but now the bank is also saying that if your business didn't really come through, then you personally are. And, obviously, as you have, let's say, multiple LLCs or different land holdings, I mean, you do this for a variety of reasons. One is to kind of, strategically have different businesses, but also I've heard of people, like, if you're a builder in particular, I want my land business to be in an LLC so that if something happened to my home business, my land business is not in jeopardy, or vice versa, and so I guess a little bit of church and state dividing some of your risk. Walk us through that from the bank's point of view when you're talking about personal guarantees and kind of the nuance of that.
Yeah. Sure. I mean, the bank kind of looks at it the opposite from you. They figure, well, if you're the owner, you're driving it, you're making the decisions, you control it. It's almost more of a psychological thing than anything else. If there is a hiccup in one part of your business, they want to make sure that you're still at the table and you're going to do whatever you can to complete the house. We don't want to come and finish and construct a house, right? So it's pretty common for personal guarantees. You have to get to be a certain size where you're throwing off enough cash flow that you could really tap the capital markets. And then you can argue, well, you don't really need a personal guarantee anymore.
Like what number, what threshold would you even be talking about?
It depends on the industry. I guess on the construction side, I can think of contractors we've got who are, revenues north of $100 million, and they're, rock solid balance sheets and plenty of collateral and many years of earnings. So they can probably competitively argue that they don't need a personal guarantee. The business stands by itself.
But a banker would most likely ask for one.
They're always going to ask.
Yeah, they're always going to ask, and then that's the negotiation thing of saying, "I don't."
Yeah,
you push back a little bit. What would be so? Just for those listening, I mean, maybe there is some, builders out there that are over 100 million, but I would imagine a lot of them are, let's say, let's 4 million, 8 million,
Correct.
15 million, 20 million, 30 million. Let's just say anything under 30 million, you're going to ask for a personal guarantee, or going to require it. Not even ask for it, because I think it's based on your smiles. We're asking for it regardless.
Yep.
At what point would it sort of be like, no, we need one, or we're not loaning it?
Yeah, I would say definitely, when you're developing a relationship, that's obviously the play where there's not a background or experience play. So we're definitely going to be asking for that personal guarantee at the beginning to really make sure that there's that connection point, that if we don't know who you are, or we haven't worked with you enough as XYZ, company, construction company, we need to know how you operate. We need to know how, when we ask you for something because we're trying to help you and you don't respond to us for 3 weeks because we need updated documentation for a financial play or just review, then all of a sudden it's going to be concerning to us that what our brains are always, what's going to happen next? What's the next problem that's going to come out of this, versus trying to work with that client. If they're responsive, then maybe you've done 5 houses, 6 houses, 10 houses, and everything's worked to date. The balances are growing, business is growing. You come to us and say, hey, can we move on to the next step with our relationship? Of course. Let's take a look and entertain it.
And I like that answer, because you're really talking about reverse relationship, which is what the whole thing is based on. I mean, when I build a home, I want to have, our biggest differentiator in building a home is the same thing. Like, a lot of people can build you a high quality home, but what's the experience going to be like, during this process as well? So I certainly appreciate that. And I can understand too that after decades of working together, or whatever the relationship is, I also appreciate a bank sort of in some ways being a safety net. Like, I tend to be an extreme optimist. And so in some ways, the people on your team need to sort of help you have some reality checks too. So I would appreciate a bank, or in Steve's case, of not just saying yes to everything, but also as a trusted partner. I think that's the whole point. If you surround yourself with 5, yes men and women, how does that really help you if you decide to do something really dumb? And so, I mean, with that kind of in mind, do you guys have any stories of basically people who have asked you for advice and, you maybe encouraged them to do something they didn't want to do and it worked out well, or anybody that came forward and said, hey, I want to do this, and you're like, no, I think and these are the reasons why, and you sort of redirected them?
I can think of one back in my early in my career where a client had a home equity line of credit, and this was, you couldn't tap it. You had to call the banker to access it. Maybe we didn't have ATM cards or something. But the guy was in Vegas, and he was on a losing streak, and he gets a hold of me, and he wants me to send him the money, and I wouldn't do it. And I don't think that was even legal.
No.
But I said, call me in the morning. Call me in the morning. I would not do it.
That's actually pretty good. I mean, that was actually even, I think a child could even pick that one out. Like, good call, Eric. You're like, yeah, we're not freeing this up right now. You're probably not in the best state of mind.
Right.
Yep.
It really comes down to the couple stories I've had, and maybe I'll just hit on one, is you just have people that are too reactionary. You kind of know that read at the beginning where people are just like, it's like a shiny little object. I want to get that. And it's the people that are making those quick, rash decisions when they're not thinking it through. You just got to try to talk them down a little bit and say, hey, here's what I would tell you to do. You make the ultimate decision, but I don't think this is the best course, action for you to take at this point. And it's their choice. But if I'm a trusted advisor, I should be telling them, like you said, I should be telling them, no, I don't think it's in your best interest for these reasons. And that's the biggest play for me.
How often does a good banker reach out to their client and say, hey, I've observed your cash flow, and I have some questions, or you're using analytics in some way to reach out to them, either with an opportunity, and I don't know how often, I don't even know what's allowed in banking. Like if you had one client who provide, I'm just a builder, so let's say you had a window client. I mean, how often does the banker play matchmaker and sort of line up relationships? Maybe more in the commercial world, I don't know. But how often are you guys looking and kind of reviewing kind of your assets and holding and saying, oh, I need to reach out to Mark because I'm either seeing something as sort of a metric as a red flag, or B, hey, wow, they're getting to have maybe too much money at the bank. Maybe they need to invest it and look at some opportunities. Almost the role, I mean, an active role as an advisor. Granted that hopefully that's coming up in your quarterly conversations, I would assume. But
Correct.
I mean, how often does something like that even occur?
From a private banking standpoint, that's where those annual, semi-annual meetings really come to play, like you mentioned, Mark. For really the next step, it's making sure that I have those outlets there. I don't know if I'm proactively looking to do matchmaker all the time, but ultimately at the end of the day, if there's a need and there's a connection point I should be making, an introduction, because I hear you say, hey, we're going to buy a new property and we're looking for existing. I've got 2 or 3 private mortgage bankers that have been connected. I've been connected with for 20 years, that as soon as I hear that, I'll be, the next part of the conversation is, hey, I should introduce you here.
And, and this is a major kudos to you personally, Steve, but I mean, I've done this for, as I mentioned, 20 years. And, you have led to 2 direct builds where I've built homes. And this is going to put a lot of pressure on the bankers out there, or the builders right now after they listen to this are going to call their banker and be like, hey, Mark has gotten 2 build jobs from his banker. What have you done for me? But, that was pretty special. I mean, you had 2, and I think it was a mutual, I think it helped both parties. I think one client of yours had a kind of a bad run with 2 other builders, and they kind of came to me. And, if this person's listening, I really do think he's amazing. And you said, I mean, he's a bear. Know that he's a bear. And like, if you go into a cage with a bear and don't know it's a bear, like you're going to get mauled. And there's that line that, like the guilty flee when no man pursueth. It's in Proverbs. But like, if you're honest about what you're doing, you have really nothing to fear. And I was like, bring it on. And he ended up being one of my favorite clients. He was so respectful, so matter of fact, to the point. And, but I remember looking around being like, man, if this goes sideways, like I'm going to get my jugular ripped out. But I mean, as long as, but he appreciated brutal honesty.
Correct.
And anyway, I think very fondly of him because it went so well. And anyway, now I kind of want to call the guy and take him out for lunch again. But actually, we have a standing date once a year, right around 4th of July. Yeah, I go on his boat and we just reminisce, and you would know who this is. And he's just a hoot of a character of a guy. And so I think I told him that one time. And I said, I was able to kind of joke with him. I think I even told him. I used to send him like little gifts of a bear, like mauling somebody. And I was like, I mean, I know who you are. And he's like, I appreciate that. He's like, we're going to have a great relationship. And he was always super gracious and great. So, I mean, don't be afraid of someone that maybe
Don't fear the bear.
Don't fear the bear.
Right.
Just make sure they have lots of salmon. And, bears do eat a lot of berries and other things. Just don't go around them when they're hungry. This episode is brought to you by Adaptive, the software for builders that automates draws, budgets, and bookkeeping with AI. For over a year now, I've been partnered with Adaptive, and they've just been an amazing game changer in terms of efficiency in our time and all our bookkeeping. From the time we get an invoice, we import it into their system. The AI codes it, cost codes it, job codes it. All we have to do is review it, pass it through the people internally in the office, all digitally, and then it gets approved and paid all via ACH. It's becoming extremely fast and saving us countless hours a day and a week. When it comes to draws, all of our budgets now are set in Adaptive as well. So now when we cost code against the draws, we can do our change orders, and then with a click of a button, we can submit these draws to our title companies or to our homeowners for faster payment. If you're looking to save time, and if you're looking to be accurate, I highly recommend Adaptive. Additionally, if you'd like to listen to one of their founders share the story of Adaptive, you can listen to episode number 15 on the Curious Builder Podcast. This episode is brought to you by Pella Northland. For 19.5 years, I've been building homes, and 95% of all of my homes have used Pella windows. I couldn't be happier to call them a partner in our builds and our remodels. Whether you're an architect, a designer, or a remodeler, I'd highly recommend Pella windows. They can fit old homes, new homes, reclaimed, commercial, and really everything in between. Pella is a company that we trust and that we recommend to our clients. Additionally, in management, Peter and Ed have just been absolute fantastic people to work with, as well as mentors to me personally. So when it comes time to look for a window, I'd highly recommend Pella Windows. Find more at pellanorthland.com. Also, if you're interested, you can hear episode 1 where I interview Peter and Ed together for a great listen on business and Pella Windows. So anyway,
I love it.
I kind of derailed just that your banker can obviously be a source of income. I mean, or basically a way of playing matchmaker to lead us.
Yeah, and really just finding those connections. If we're doing our trusted advisor role properly, we should have those connections where I'm listening to our conversation, and if I hear something that can be beneficial, it's either at that point or planting that seed for next time that we talk, to make sure that you've been going down your pathway properly to make sure you're on track.
So I have a question for you, Eric. So I'll just use maybe an example that I'm thinking of. So I would like to, let's say, buy a building or build a building, and I know 3 or 4 other businesses that would like to do it together. But let's just say I don't. And I would come to you and I say, Eric, you know what? I want to build like a 5-unit office building. It's way beyond my punching weight to do it alone. But I think this is a valid business move and yada, yada, yada. I either need some funding, whether it's, private capital or someone within your bank, or do you know any of your other clients that are also looking to do something similar? How often does that come up in commercial? Because it feels like, like movies, that's like, MGM or Lionsgate, like these movie companies do like deals together and you essentially be a broker. How often does a company come to you and ask for other partners to, let's say, get some sort of deal off the ground?
Sure. So, there's probably a distinction between what we call C&I lending, commercial and industrial. So think of manufacturers, wholesalers, retailers, and CRE, commercial real estate, and even more specifically, investment real estate. So we have a couple of investment real estate bankers in our group, and that's what they do. They have relationships with developers, sponsors. That world's really changed over the last 20 years or so. But yeah, if you came to me and said, I'm looking for some partners, I would just get one of those guys to talk to because they have the contacts in the industry.
Yeah. Again, playing no different than someone saying, hey, I need a really great cabinet guy. I mean, it's kind of who back to the relationship piece. Like, seems like every good business always comes back to relationships at some point. If I was going to do a development, so this is actually kind of a fairly close ideal that I would like to know the answer to. So I see, a larger development. A smaller one I get, maybe it's a 1-off, 2-off, a lot split, something like that. I'd work with Steve. Let's say we find like a 50-lot development, way too big for Mark Williams Custom Homes. But let's say I have 4 or 5 builders that I really trust and I want to work with. Walk me high level. How would something like that work? Let's just keep it 4 because it's simple. And we're going to come, I assume we'd walk us through that. We come to the bank. Each one of us would have our business pro forma and our, balance sheets and just letting you know who we are. But we want to do a a bank loan because all four of us together are going to be stronger to borrow this money to develop. Because you see these developments, this development is sponsored by, so-and-so bank. Right. Walk me through the mechanics of how something like that would work, because I have to imagine it's kind of messy because any partnership can be kind of difficult. In this case, you're talking about it's not a partnership within one company. You're talking partnerships with other companies to do a common goal. Does that happen or not really?
Yeah, it does and it doesn't. Let me go high level here for two different pathways, and Eric, jump in too, because this is a little bit more on the commercial space. But because I do a lot of the residential construction side, I know enough to be dangerous here. It depends on what relationship's been built already with their bank. For example, there maybe they're with Minnesota Bank and Trust, for example, and even though 2 of the 4 partners have banked with us or have banked with us, they may be coming to us and we can get introduction, but we may already feel comfortable with the 2 existing relationships to be like, let's just take a look at all the financials from those 2 new parties, and really at the end of the day, just come up with a common goal. Or those other parties that don't have a connection with us maybe want to continue using their existing bank to leverage some type of investment tool, even if it's off to the side, to be a fallback. So there's kind of 2 different ways, and I'm going to keep it high level there, Eric, if you have anything else.
Sure. So I can tell you that like land development loans, you're talking about buying it and doing the improvements, right? And then building homes on
Let's
it.
say buying, 50 acres, tearing down a couple of homes, new roads, that whole thing, the platting, the whole shebang.
It used to be, I think, that most banks did that. Now very few do it. I think there's more on the community bank side, and then there's just banks that are specialized where there's hard money lenders. So you're going to pay more money, but commercial banks have really kind of pulled out of the land development type projects, to be honest.
When you say hard money, explain that a little bit. Are you saying like basically you can borrow this at a set rate and that's it?
Well, they're not bankers. So their cost of funds are higher, so it's just more expensive. And they're really just looking at the asset, right? They're going to take a mortgage just like a bank would, but it's going to be pricier, higher fees, higher rate, but they can get it done.
I see. I mean, what is the difference between hard money lending and, say, venture capitalists or like a private investor? Or are they all
It'd be similar.
Okay.
It's just that they're specialized on real estate projects.
Okay, correct.
Where private equity might be any sort of industry, high tech, medical, you name it.
We had, this was a question that came up. We had Chris Anderson on maybe 10, 20 episodes ago, and it was really interesting. He does accounting bookwork for builders all across the country. And he had basically said that a healthy construction company, from what he saw, ran a 20% margin, 10% overhead, 10% profit at the end of the year. According, he, let's say, has 500, different books that he's looking at and talking to other businesses. And I thought that was really helpful for him to sort of talk high level, comparing, every market's going to be maybe slightly different, but that's a healthy business. As your business owners, as bankers on your side working with business owners, what do you see a healthy company, like kind of rates of return and investments? And let's keep this, obviously not the 100 million example, because I love it when people say, "Oh, we'll solve our problems with quantity," but I don't. That doesn't really relate to me. You build a handful of homes, but let's just say you're a company of, let's say, 40 million or 30 million or less. Walk us through like other spaces, whether it's retail, obviously construction. What are some observations that you've seen in terms of like, what is a healthy profit margin?
Sure.
And I'll hedge this with this. I feel that building in particular, I think for whatever reason, we undercharge for the amount of risk that we take. And I remember a CPA years ago told me, he goes, of all my clients, he said, builders take more risk with less return than any other business I've ever looked at. So with that kind of lead in, what's your assessment of that?
I can start with this. So every industry is different. So bankers, we do have access to industry information where they roll up, so if it's transportation or if it's food, or I can think of one company that's in the functional beverage space. I didn't know there was such a space.
Yeah. What is a functional beverage?
Well, it's like, flavor shots or something you can see. And the margins on that are just crazy. Oh, here's another one.
Like what are they?
I'll think of another one. Craft beer. So you go buy craft beer. Used to be $5. Now it's $6-7. The cost to make that is very little. It's just water and, a little barley. So it might be a 90%, gross profit margin.
Wow.
But then you've got the capital costs with all the equipment and so forth. So we look at it, we'll compare your business to others in the industry. And when we're having those preliminary conversations, we might say, okay, your gross profit margin is higher or lower than these similar type companies in the same industry. We'll just start poking at that or asking questions. And your overhead's too high or it's too low or whatever. So we'll try to add some value that way.
Are you looking at like historical countrywide data, city data, or not city data, but state data? Or are you looking at only within your own company data in order to find out some of these numbers?
No, it's nationwide sort of publications that provide it that are industry specific.
Okay, that answered my question.
And as far as the return, honestly, that's probably the difference between a commercial banker and an investment banker. We just want to get repaid, right? We want to get our principal back, a little bit of interest. We want you to succeed, but I've never felt like, maybe it's different in the private banking space, that I'm not going to tell you whether or not it's a good investment, right? Because that's really more on an investment banking perspective. And maybe, your accountant, whatever. If you do something crazy, I might, wave my hand. Like if you're
in Vegas and you call and say, hey, I need to liquidate my company. So
no, just hard no.
Call me in the morning.
But in general, so I guess your client, they would have to understand that's what the commercial banker's paradigm is. They're just trying to get their principal back. They don't want to take a lot of undue risk. That's why they're looking at the profits. They want collateral. They want personal guarantees because they don't want to lose their principal.
Right. Okay. And I'll jump in real quick too. I think, Mark, you mentioned it, the thin margins possibly in construction. Since I see the consumer side of it, I'm sitting on their side of the house, kind of just trying to help them go through a cost of everything that we're going to help them along the way. This is their big ticket item in their entire lifetime, right? If they're building a $2 to $3 million property, and those numbers, when it comes to profit for builder, overhead, supervision, when you're dealing with $2, $3, $4 million properties, even though at the end of the day they're financially sound, they're shrewd. They got there for a reason, and they'll look at that number. It's a big number when it's 10% of a build, right? And they'll look at that, and for them, that could be a hindrance possibly. The sell-through, I think, is what we try to do, and I think what you try to do is that, of course, there's got to be some type of profit for me in here because I'm going to help you build your dream. And it's selling that message to the individual that there's a cost to do everything. If you take whatever their business is, they have their own profit margin. They're trying to make money. You're doing the same, but you're also there partnering with them on this wonderful opportunity for their dream home to be built. And I think once you educate them that what I'm going to bring is your trusted advisor, meaning you, Mark Williams, to the table, I would be so much more appreciative if I knew that I have a partner in this building of this house, because you don't want to have a problem come up where really I'm just trying to cut margins and do whatever I can to build you a house and I'm going to move on. It's back to that whole trusted advisor. I know I sound like a broken record, but it's the same piece in your aspect. Even though it's a big number, why is it a big number? Here's what I'm going to do for you.
Obviously, if you're doing a fixed bid, the client isn't necessarily in your kitchen cooking.
True.
But can you think of any other business that ends up being so transparent in how it accumulates its costs than building is? I was thinking about, you guys are both shrugging right now, nope, we know it already. I was telling someone this the other day, and I was trying to explain, and we won't go into this podcast, the whole difference between cost plus and fixed bid and all the pros and cons, and you could almost do an entire podcast on that, really, and it'd be helpful. But, in short, it's you go to the car dealership and, they do a very good job, of course, listing out their options. But it's not like if they do the heated seats, so how much does the wires cost in this? And what's the labor? And what's your margin rate? That's just not expected. It just seems kind of crazy to me that the most expensive thing that most people ever buy want to know every single cost on it. And yet why that's sort of normal for us to also share that. And I don't know when that became a thing or if it's always been that way. Yeah, I don't know.
Yeah, with the sworn construction statement, and all the subcontractors, so they know exactly what you're having to pay, and then you build on your profit margin or 10% or whatever it is, right?
Right.
Yeah, it is very transparent.
Yeah, but is there any other industry you can think of that's like that?
That shares all their cost of goods sold? Yeah.
Not many, if any, that I can think of.
Yeah.
Right. That's okay. Well, I'm not sure if that makes me feel good or bad. A couple sort of banking questions just in general, and this is, why is this kind of like shooting down myths? So why do a lot of people, and maybe I'm obviously in business, so I don't feel this way, but I feel like there's a perception, and maybe it's a perception of people that aren't business owners. Why do people have a bias against banks? Like, especially like in the news media, you have a lot of bias, and this is not meant to be a political conversation. It could easily go that way. But like from the standpoint of like, there's a lot of speculation about Wall Street and like, down with Wall Street, and that's a whole ideology. But in general, it seems like a lot of people just don't trust banks. Like, where does that come from? Like, why would that be? Because as a business owner, like, I need your help. As we've already said, we're telling business owners that are listening to this podcast, like, bring your banker in closer than however close they are now, bring them in closer. Because chances are you haven't talked to them in the last month, would be my guess. And so how do you dispel this rumor that, you hear this thought like, I don't even know where this, picture comes from, but like a rich fat cat, like you hear that analogy, like, and every company or every business has stereotypes. Builders have stereotypes, copier salesmen, car salesmen. Where does this banking myth come from, and how often do you run into it?
They used to, I was at a succession planning conference last year, and the business owners stack ranked all their advisors, and the bankers were at the bottom. And we used to be above the lawyers. And like somehow now, and I think a lot of it is all the mergers and acquisitions, and there's turnover, and maybe there are some bad actors out there. I mean, the fact that I've had relationships for 3 generations. I mean, you have integrity, trust, right? That's what we strive for. That's why we're in the business. There aren't enough good movies about bankers. They're always about evil,
right.
Debauchery on Wall Street, right? The only good movie about the community banker is got to be It's a Wonderful Life with the Jimmy Stewart, where he's at the savings and loan. He's at the building and loan, and he saves the day. And
so really, the bank, you guys need to collectively go to Hollywood and start pitching some more positives.
Yeah, but who wants that? Doesn't sell.
Yeah, well, interesting.
Yeah, I'll interject something here that I found. In today's day and age, it's hard to move your banking account. Maybe that's the best way to say it. And the reason I mention that is that a lot of stories and conversations, when I'm introduced to somebody and we get to talking, it's all about trust and rapport. We don't even talk about bank at the beginning. When you get to the point, like, where are you at now? What tool services? A lot of times we find that these clients have been at Wells Fargo and U.S. Bank, and I bring up names just because they're readily known, and they're convenient. They're phenomenal. Their online banking is phenomenal. However, that's what they're good at. They're good for the masses. And when someone started at, let's say, right out of college, that was their first bank account, and they built and they grown, and they didn't need a lot when they were younger. When they get to that point where they're more successful in their life and their career, and they realize they need that trusted advisor that we keep going back to, they may pick up a phone call to one of those larger institutions and find out they're just a number. They don't have a connection built. And usually that's the point where they need something relatively quick. And our whole play is, hey, if you're happy with that and you don't need a lot of services, we're never going to talk bad about another counterpart because they probably have some benefit there. But if you are experiencing issues and you're starting to get successful, you run a successful business, that's that point where you're not getting that added benefit, that value to sit down with a banker, a trusted advisor. Doesn't matter of the trusted advisors we've spoken to really dig in deep, because there's other components that can help you grow your business. And that's where we feel we bring in. And the community bank, regional bank role that Eric and I played in during most, if not all, of our careers, that's what we bring to the table that we feel is different than just the convenience of having an online banking tool. We have all that too, but we take it one step further because we bring the value add when it comes to that relationship.
During the PPP, the pandemic, when the government said, here's this new program, and banks, can you please stand this up? I mean, if you didn't have a banker, a human being you could call, if you were at one of the big banks and you're just calling in, I mean, they were out of luck. So that was kind of our finest hour. I wouldn't want to go through it again, but it really helped. It really felt good. We were the only ones who could deliver this program. The sky was falling, and we helped out our customers.
Talk a little bit, in the remaining time here, 13 minutes. Tell us a little bit about the industry of banking. High level, if I was to answer my own question here, how do banks make money? You borrow it at one rate. We charge an interest that's higher than what you're borrowing it at.
That's our margin.
And you make, on your margin, which is, by the way, is probably pretty low.
It's very low.
Extremely.
And so, speaking of low margins, maybe the CPA for the bankers are like, So walk us through like just banking in general. Recently you guys, it's pretty hot off the press. Actually, you guys was it merged or
we've announced a merger with another regional publicly traded bank.
Yep. And now, I don't know the answer to this. What is the difference between a merger and being bought out? What is semantics?
It is semantics. There's somebody. It's going to be somebody's stock and somebody's brand. In this case, the merger is between two similar size regional publicly traded banks. So it's not a giant bank gobbling up a small one. So it's a merger. There will be interplay between the two teams, but at the end of the day, it's the bigger bank. It'll be their brand and their stock.
Correct. And what are some of the advantages of a bank? Like when a bank first starts, they're a small community bank. Most likely they go to past clients, like when Signature Bank, first started. And Signature Bank was around for 15 years?
15-ish.
And then they sold out to Minnesota Bank and Trust, or merged, or however you want to say that. What was I guess just walk through your bank specifically. What was some of the things at play? Why do that? And then why? Now it's been, 8 years, 9 years, and then kind of doing it again. So it's kind of sizing up. Is it just becoming a bigger, and has more capital, so it could do more funds? I mean, there's got to be some pros here as well, right?
100%. It's economies of scale as you continue to grow and go up channel, be able to service a client longer in the duration of their life cycle, because our legal lending limit continues to go up. So you don't have to start with a small business client, get to a point where you max out with that client, can no longer lend them more money to
What do you mean by that exactly?
Yeah, based on the size of a bank, there's usually a legal lending limit that says that the bank per one entity or entities has a cap as to how much we can lend to each one of those. It's more internal risk as well as external review. And I can let Eric go into that a little bit more. But really, at the end of the day, we're trying to find more ways to bring stuff to our clients, more benefits, more services, more products. And I think that as smaller banks realize the world of compliance continues, especially on the retail side or private side, it's tough to stay on top of all the rules and regulations. And if you go wrong or go haywire and forget something or do something wrong or, heaven forbid, underwrite something and you miss something, and all of a sudden you're in review from FDIC or OCC or whoever comes through and reviews, you could get fined, and that could take you under. So
the fine alone could take you under?
Potentially, based on the severity or what, if you're egregious in going over and doing it over and over again. There's certain things that come in. There's been a lot of factors too. With Eric mentioned earlier, our margins are thin. You mentioned it too, that some banks have just gotten to that point where it's too razor thin for us to keep going. And the shareholders maybe went through the whole pandemic and we didn't know what we'd do. There was a raise of capital, and now it's time to move on. Let's cash in their chips and try to move on. That's where those community banks start, and it all depends on what the makeup and the goal is. But Eric, I'll let you jump in.
There's since Signature Bank was started, I think there's been one de novo new bank started in Minnesota, Entree Bank.
That's correct.
Right?
Yep.
Really? In like 20 years.
Correct. Oh, wow.
Because
I didn't realize it was that rare of air.
Yeah, it's really rare. And part of it is, I think the minimum capital requirement the regulators will require is like $20 million. So you and your friends have got to come up and get $20 million, and you're just not going to get the kind of return that you probably can make building homes. So it's not as lucrative. And that's why you were seeing more consolidation in the industry, because margins are being compressed. The cost of technology, compliance, talent, right? The overhead's just getting higher. And so I think you're just going to see more and more consolidation.
So there's less banks today than there were 10 years ago?
Yeah, sure. But we still have, if you go to Canada, there are 5 banks. 5. And I don't know, there are probably 500 in the state of Minnesota, so we're still a long ways away from having national banks.
So that was interesting. I know somebody that, and maybe if you open up another branch, so this particular bank I think has opened up like 2 or 3 branches in the last 4 or 5 years, which is not a new bank. So it's been 20 years since a new bank started. Mm-hmm. What is the difference between a new bank and starting a new branch?
You can always open up a new branch. And in fact, I think the regulators like it because you're going into new communities and accepting deposits, lending out. So it's not a big deal. It's just bricks and mortar. Right. And that's kind of a dirty word in banking now because most people don't go into the bank that much. It's all online, right? You don't need as many tellers. I remember when I started my career, the drive up on payday, the cars would be around the block. And now it's just everybody's, paycheck is auto deposited. So it's just, you don't need as many branches.
I mean, you guys do have good Ghirardelli chocolate in the lobby at Minnesota Bank and Trust. Although I haven't been in a long time. I used to always go in there and grab an apple just because I used to always be like, well, I want to reward the one person who's putting out apples here instead of eating those chocolates. So, well, that's pretty interesting. What other advice would you give people as they are either starting a business in terms of like when they approach when they approach a bank and saying, hey, this is what I would like to do? Because I think in the very beginning, we obviously started somewhere, and my relationship really started on a relationship that, in this case, my dad had, right? And so a lot of people get referred to a bank. But,
Correct.
You see people out there where there's a change. Now, we had to change Ryan. Shout out to Ryan. Ryan was great. He was, my personal banker for a long time. And, when, just like any sales rep, we've talked about this a lot on the podcast, my relationship really with housing or with Minnesota Bank and Trust is with you, Steve.
Right.
And so it's kind of interesting that as the companies get bigger, in some ways, the relationship between a builder or any company gets smaller with their specific person. Like if you were to leave and go somewhere else, it's like that door is open. Mm-hmm. Now that's true of any business because the pro of a relationship is it's very sticky. Correct. The con of it is if you are the parent company and Steve leaves, it's very sticky. There's a good chance that Steve could take me with him, right? Sure. Potentially. Mm-hmm. How do banks sort of manage that? I mean, how does any business manage that for that fact?
Well, it's interesting. So we've been reaching out to our key clients to alert them to the merger news. We prefer that they hear it from us rather than hearing it, although it's hard. Information goes out so quickly. And like every customer I talked to, they said, okay, that makes sense. Okay, I've never heard of that bank, but that's fine. What are you going to stick around, right? Because that's important to them. Because you know their business. Part of it is who wants to retrain a new banker on their business because every business is unique. But then you've built up trust over the years that you've got them through tough times and delivered for them. One thing that we do try to do is introduce people to different folks at the bank. So on the commercial side, we're primarily lenders, but then we have the whole deposit, the treasury management piece, and those are our partners. So hopefully they know a lender, they know a treasury management person, maybe they know a private banker on the ownership side. So if they know multiple people and one person leaves, they're less likely to just bail.
Right. Mm-hmm. Right. And one of the other pieces going back to the economies of scale is we're growing. If we're doing our job too, the bigger the bank doesn't always mean a bad thing. If we're community bank first, and that's kind of the mentality, which is what our merger position is going to be, we want to be able to be holistic for that client as offer as many things. And it does go down the sticky path, of course, but if you can come to one location and get a credit card, we have our own internal credit card program, which most banks our size don't. We have wealth management, like Eric said, where you can be at any stage of your business, and we should have all those tools underneath one roof versus you just kind of piecemealing one piece of the banking side here, and then I've got to refer you to somebody else outside. So as you get bigger, you have that benefit of being able to expand that relationship with that client in-house, and we've already got those tools there ready to go for when that client hits that milestone, hits that next stage in their career, their pathway, whatever.
Well, interesting. I mean, we could talk about a number of other topics. As we come up here at the end, I always like to kind of end it a little bit with just some personal stuff. I'll start with you, Eric, but, what are some things that you do to sort of, further your own education, whether it's banking or business or, basically what keeps you going? I mean, you've been doing this for 40 years and, here you are getting, agreeing to a podcast, you poor guy. And, I mean, you clearly love what you do. What are some things that kind of feed your engine, both either personally or professionally?
So in terms of reading, I mean, honestly, I still read newspapers, although I guess I don't read the actual newsprint now. It's all electronic. I try to read a lot. And you can get a lot of information about the industry and the economy. So I still enjoy it. The industry to me is fascinating. I mean, every day, I enjoy the work. I enjoy the variety of it. I enjoy the service aspect of it. We manage all kinds of risks. In my role, I lead a team. So then you've got individuals at different stages of their career, and you're trying to help them develop. I find that very rewarding. And, of course, the relationships I have with the clients over years.
Yeah. How about you, Steve?
Yeah, I'd say the same thing. I'm kind of a sponge when it comes to the technology side. I love how technology has been able to make our lives easier. So I always try to stay in front of it. We're never going to, in the banking world, have the most cutting edge technology. We're always slow to adapt. But if you kind of stay near the top, there's ways that we can make it better for our clients. So I always want to be on the forefront of what's going on. That's what kind of drives me. Current events are needed just so you can have a normal conversation. Because if you heard me say at the beginning, I usually, when I first meet a client, we're not talking products. We're talking about backgrounds, who we are, what we're doing. I'm building that trust level up. And just to be kind of versed in all different topics and know enough to be dangerous. The master of, some type of product is good, but if you can't just go outside that space and know a little bit of what's going on, then you kind of just look like you're just there for one purpose only. So I try to be at least up to date on things, as well as you heard me say with the technology play. That's kind of a fuel for me.
Sure. And for those listening, if they want to, whether you're a business or just want to reach out personally, what are some of the best ways to get a hold of you? Would it be through LinkedIn? Would it be just is that probably the easiest?
I have a LinkedIn. Sure. Yeah. Yep.
Okay.
Yep. Same. LinkedIn is the best.
All right. We'll have that in the show notes. Again, I want to thank you guys for coming on and really appreciate it. And thanks for tuning in to the Curious Builder Podcast. Thanks for listening to the Curious Builder Podcast. If you like what you listen to, please give us a 5-star rating and write us a review. It really means a lot. It's a great way for us to just understand what you like about the podcast and what we can keep doing. So like and review, and please share with your friends and family. Find out more at curiousbuilderpodcast.com.